Hello, everyone. Welcome to the AAPI educational webinar series about investment, estate, and tax planning for physicians. We have had several successful sessions prior to this, well attended by a lot of members. All attendees should consult their own advisors and attorneys for any advice. AAPI's goal is to educate its member about the importance of financial planning and becoming financially independent. We have Mr. Syed Nishat with us. Mr. Nishat is a fiduciary financial advisor and partner at the Wall Street Alliance Group. His articles and interviews about his asset protection and common financial mistakes made by physicians are published in MedPage Today and Medscape. He is regularly quoted and interviewed in media outlets like Forbes, Kevin MD, US News, Investment News, and Yahoo Finance. We would like to make it more audience interactive and not like a boring presentation. I will ask questions and Mr. Nishat will answer them. You can also ask your questions as well in the chat box. Again, please ask your questions in the chat box and Mr. Nishat will try to answer your question. Mr. Nishat, thank you for coming.
Uh,
We welcome you to this meeting. Thank you.
Thank you, Dr. Samadder, for inviting me. And for the audience, today will be fun because Dr. Samadder asked me to come as a financial advisor and asked me to speak to you why not to use a financial advisor. So it will be fun. When I told my a group, they said you are, shooting in your own foot. But we are here to, as Dr. Samadder mentioned, financial independency, no financial advisor, how to do it yourself. Hopefully, after this session, a lot of things you can do by yourself.
Okay, thank you, Sayed. The first question I would like to ask you is can you please outline the top 5 financial planning goals for physicians this year?
Yeah, it's a great question. So just to start this webinar in a light topic, because a lot of people are still coming in. So as a financial advisor, we are a fiduciary financial advisor, and we have been doing it for about almost 20 years. And for physician, they have different goals, but these are the top 5 goals. I think if you can focus a little bit as a physician, it will not only help you in your just a financial plan, it should help you in your quality of life as well. So number one in a financial planning goal, I mean, we are talking about in the middle of the year, but some of them, quite of them could be implemented and it will give you a good boost for 2024. Number one for physician, make health as a priority. Dr. Samadar, you'll be surprised, like a lot of physician, physically, they are not, that great. I mean, like I was talking to one of the physician, I asked the question, when was the last time you went to a physician? The answer was no, they don't, because all they do is work, work, work. So it's very important to make health as a priority. Work will be there. Don't work like you are doing, Dr. Samadar, 8 p.m. Coming to AAPI webinar. Do your own thing, commingle with friends, have a good life. And in our community, Dr. Samadar, people don't want to talk about mental health. It's a taboo. I'm a macho man. I can take it. I'm from India. I can handle it. I got it, but listen, there's only so much body can take. So try to enjoy your life, take care of your physical and mental health. Very, very important. Health is the number one priority. Number two, I think that is very important is for physician, update your will and trust as a financial plan. I mean, we are very busy making money, but we need to organize all the assets we have. So try to update your estate planning because children now older, the will has been done like 10 years ago. It's good time to update it. A new law has been passed. So again, make sure update your will and trust. That's number two, very important. Number three, Dr. Samadar, you'll be surprised. A lot of physician, my clients, they don't involve their spouses in financial plan in both sides. Like if a wife is a physician, don't want to involve husband or husband. So it's very important to actually have come together in a financial planning session. They don't involve their spouse and the husband pass away. A lot of time, wife is a housewife, and it's a big job though of his own to raise the children, and suddenly they have no idea what's going on with the finances, and so that's very important to involve your spouses in the financial plan, and at one point, involve your children as well. What I'm saying, involving your children, you don't have to tell them your net worth, but at least tell them if anything happens to you and your wife, where is the copy of the documents? So at least they can go after it. We have incidents like both husband and wife both pass away. We have no clue what the documents are. It was a complete nightmare. So very important, involve your spouses and children in the financial plan. And the last two, we're talking at the beginning of the year, Dr. Samadar. I think a lot of time physicians come to us in December or April of next year for this year. It's too late. Nothing can be done. But this year, we're talking in May, is 2024. A lot of cool stuff you can do. The best investment you can do, hire a good CPA. So organize your tax planning. I don't know if you know it, that the year before last year, there's something called Inflation Reduction Act government passed. It is huge. A lot of physicians are not focused on it. According to Inflation Reduction Act, IRS audit will go high. So make sure you have a good CPA who organize everything. If you have an LLC, that needs to be filed with FinCEN. It's an organization. It's a new law. So again, a lot of audits, I think, are about to happen if you make over 400,000. So make sure you have a good CPA. And lastly, from a financial planning point of view, people, especially who are close to retirement, we highly recommend diversify your investment. I know it's boring, but Samadar, I was talking to Gautamji, when I came to Ohio, and we talking about stocks. Everyone have a few stocks in common: Apple, Google, Amazon, Nvidia. 5 stocks, everyone buys it. No diversification, all tech companies, especially in our community. All we do, I see WhatsApp and chat going on, AI, high tech company. But at one point, the party will be over. So it's very important that make sure you diversify investment, because if the market goes down, especially if you're close to retirement, you don't have too much time to recover. So these 5 top planning, if you can just take a pause and kind of organize it, it will give you a big boost for 2024.
Great. Okay, speaking about investment, this is the election year, we all know. Can you please give your market outlook? What should the investor do this year?
Yeah, before this question, a lot of clients ask me the question, who's going to be the president? And, in this forum, we cannot talk about it, who's going to be the president, but it doesn't really matter, because what happened, if you take a look at the history, Dr. Samadar, for the last, in 1964, I'm talking about, the market went up almost 12 times during election years for the 1964. Only 2 times we see, if you look at the chart. It's a real chart. In 2000, 2008, the market fell. Before that, market was kind of flat, but nothing like market really crash during election year. So and on average during election year, market went up about 12% on average. One thing investors should be very careful not to time it during election year. Like in 2016, when Trump running for president, a lot of my clients sold stock before the election. No head, no tail. It's called cognitive thinking, confirmation bias in behavioral finance, we call it. No logic, they sold everything. And since then, the market went up double digit. So again, try not to time the market during election year. This year, you asked for the outlook. So what market will be derived by inflation? Very simple. So if the interest rate Fed cut it with the promise about 3 times this year, the market should rally up. If the data come out to be strong every quarter, let's say unemployment data or employment data, let's say, for example, is very strong, that means the economy is very strong, market will take a dip. That means that the Fed will not cut the rate. So overall, I think our recommendation, don't fight the Fed. For Fed, most of the times are right. Stay in the course. But my recommendation will be market went up too quickly. Dr. Samadar, I don't know if you know it. Last year, market went up 26% S&P. This year is already up 10%. So market is overbought. So if you are close to retirement, we recommend take some profit. Close to retirement, like less than 5 years, take some profit. About 20% try to sit into money market. Don't have to buy bonds, because money market is giving 5%. That's very simple. If you have a long time horizon, don't have to time the market, stay in the course. So I know it's a little vague answer, but hopefully you can sit down with your financial advisor. But our outlook overall, that market will take a short-term dip. It'll be a good opportunity to buy it, and the long run market should be higher.
Great. If you're if an investor asks you what to buy, what would you recommend?
Yeah, if one of the things I always tell our clients that this is all the time we ask what stocks to buy. We are in this webinar today to have a honest talk. Our recommendation is you don't have to buy individual stocks. You don't have to buy Apple, Google, individual stock, worry about earning, worrying about buying and selling. Because Dr. Samadder, in the long run, index funds or passive management, if you just buy, like if you just come and tell me, I have a 20 years time horizon, what should I buy? Simple answer, SPY. Everyone to know, SPY is the Standard and Poor index fund. Just buy it, leave it there. You don't have to worry about any financial advisor fee. You don't have to worry about Syed Nishat. You don't have to worry about any wow investor. It will go up. Mark my word, it will most likely will go higher in the long run if you have a 20 years time horizon. You should diversify into different index funds. I understand, but in the long run, index funds goes high. You don't have to really time it. Index funds are diversified. So our recommendation is that if you're about to buy, my suggestion is to buy ETF and index fund. In the long run, it always goes higher.
Great. Why do you recommend passive investment versus active investment?
Yeah, so a lot of times client, come to us, Dr. Samadar, and say, say, Nishat, I'm here to your firm, Wall Street Alliance Group. I want to beat the market. I mean, think logically. I'm here in webinar with you, 8 p.m. Wednesday, and I know how to beat the market, right? Should I be a billionaire right now, Dr. Samadar? I don't have to be here, right? I would be like making so much money. I should be in Florida, in a yacht. But I don't know how to beat the market. No one knows how to beat the market. And if you look at the history, on the left side, you see active management large cap. In the middle, you see SPY, Standard & Poor 500. Take a look. 92% of active management underperform SPY. 92%. 8% people beat it, but they are usually one-leg pony. That means that sometimes they beat it, sometimes they don't beat it. For example, Cathie Wood. I'm not saying that there's a bad fund, but Cathie Wood, for example, made a lot of money a couple of years ago, but now severely underperforming for a long period of time. So again, we highly recommend index fund, ETF, passive management is the way to go. You do not need a financial advisor or hedge fund people to beat the market. You can do it independently of your own if you have time and patience.
So if you're suggesting passive management, why should we use financial advisors like you and pay any fees?
You don't have to. That's why we're here. So the reason why people come to us because still, there's a lot of confusion. Is still they want the hormonal, rush running to buy, sell stock. That's why they use financial advisors a lot of times, which I don't think is necessary. But the real answer is that you want to come to us or any financial advisor, just to give you an idea, to other services beside investment management. As I mentioned, investment management, if you buy index funds, I'm telling you in the long run, most likely you should be fine. SPY, long run, outperform anything else. But if you need help in estate planning, will, trust, asset protection, by the way, I need those services. Do you have it? Yes, we have the whole team. And most financial advisors who are successful have a team like this. So people use financial advisor for financial plan, for other services. But by providing other service, can you take care of my investment manager as well? Sure. So usually they give a portion of their investment for the management, plus they usually require other services like will, trust, asset protection, tax planning. This is why you want to use a financial advisor. Purely for investment management, you're making a big mistake.
Okay, can you please explain why diversification is important? And also, can you please give us some examples of passive investment and how to invest by yourself without using any financial advisors?
Sure. So I think diversification is important. It is true that SPY in the long run go higher, but putting everything into SPY may not be the best idea. If you have a 20 years time horizon, you most likely is okay, but a lot of physicians are 10-year time horizon. So I just want to give you one example here. In 2000, if you have invested into SPY, Standard and Poor, until 2010, the total return of SPY was flat, negative. But during that time, international market went up a lot. Emerging market went up almost around 9%. So in our opinion, putting everything into SPY in the long run, it should be fine. But short term, if the 10 years return come back, I think we will underperform. I think Dr. Samadder is a mistake not to invest into India. India is booming, I think. There are ETFs, index funds out there to invest into India. So that's why we believe that within index fund, you should be diversified. Now, the second question you ask, okay, can you give me some example? All right. The first, on this first thing you have to decide to some other, how much risk can you take? That's the number one. There are 4 types of portfolio. Just to simplify it, there's no rocket science here. One is conservative. Conservative means 50% should be invested into equity, 50% cash or bond. Moderate, 60%, and 40% conservative. Growth, 80% aggressive, 20% conservative. Aggressive growth, 100% equity. You take a look at how much risk can you take and you invest. Now, I will show you a growth portfolio. In index funds or ETF, how can you do it? This is, I think, a good prototype for the audience who's listening. They can take a picture of it. It will be recorded. I will email it to them. They can sit there with a financial advisor. They can buy something similar. For example, if you are more aggressive, buy more SPY. So this is the total allocation of 100%. So SPY, 25%, which is large cap. Mid cap, you have to have some 10%. Small cap, you have to have 5%. Large cap growth, which is QQQ. Everyone loves Apple, Google, Amazon. Buy QQQ 25%. I believe you should buy some international. So VWO 8%. European market around close to in the vicinity of 8%, and fixed income, which is like money market or bond, around 20%. So total, it will give you around 100% allocation of the portfolio. Now, if you want to be more aggressive or more conservative, you can just increase or decrease the sector you want. So again, this is a passive investment strategy. You can use this as a prototype. I refuse to believe, Dr. Samadder, that you are a physician, you don't know how to do that. All you have to do, take a look. You are all like went to med school for a long period of time. So you start with this, Dr. Samadder, and every 3 months, what happens if the market goes up and down, this allocation will change automatically. You just come back to this allocation, just sell some large cap, sell some mid cap, and bring it down. So in this way, the allocation pretty much remain the same. Again, these are like long-term, just buy and hold. You are just strategically changing the allocation every quarter to make sure the portfolio is diversified. So again, I hope the audience can take a look at this slide. They don't have to buy, exactly this, but they can buy something similar. But again, these are ETF-based passive management strategy. I hope it makes sense.
Yeah. What type of investments are best to avoid?
Yeah, so we're talking about investments, which are best to avoid. What I mean by avoid is be cautious. So number one, unfortunately, we see a lot of physicians are hooked into or got sold into life insurance as investment. Like they bought whole life insurance or VUL, and the dream has been given to them that, the principle is kind of safe. If you hold it for long term, you get the market upside as well. So life insurance, the whole advantage or whole use is death benefit if you pass away. So as an investment, you will be disappointed. So again, life insurance investment, we believe is a bad idea. Number two, nowadays, again, life insurance, we see in Florida, those area, people do something called premium financing. It's a life insurance again. So because the interest rate is very low, you use collateral, your assets, And with this, the premium is getting paid. Again, these are very risky because there's an interest rate risk involved into it. Annuities, we are a big component of low cost. We believe in low cost passive investment. This is as a financial advisor. Annuities are very high expensive. Almost sometimes we see if you add all the writers, almost 4%. Annuities, we recommend be careful unless you really need it. There is case can be made, but still the fees doesn't justify it. Rather buying mutual funds, I don't know if a lot of investors realize there's something called expense ratio within this mutual funds. Every year expense ratio. Plus the mutual fund pay capital gain tax as well. So again, it is not efficient. Rather buying high expensive mutual funds, we suggest buy index funds. They don't pay that much dividend. And lastly, Dr. Samadder, I recommend is private syndicate offering. Like, we see a lot of times into all these, events we go to, like private placement, like you invest into real estate. People take your money and invest into real estate of their own. The problem is that liquidity, and a lot of fraud happen as well. They give promise that distribution will happen in 3-4 months, but people get locked up for a long period of time. A small portion you can put it in, but not significant portion of your money into this kind of we see like a hotel deal or real estate deal, we see it because it is not as liquid as has been promised. So again, these are the 5 type of investments I believe that people should be worried about. Try to go for plain vanilla, simple investment, easy to understand. That will be my recommendation for the investors.
Great. A lot of investors are victim of fraud. How to choose the right financial advisors?
Yeah, if a financial advisors come to you, there's a website you can all go to called finra.org, FINRAORG, finra.org. You can go there. Like, for example, Dr. Samadar, I can search you by medical board. Same way we are registered with FINRA. There's also called sec.gov. You can go to these websites, put the first name, last name of the financial advisor, and the whole history comes in. It is not uncommon for financial advisors for a long period of time working. 1 or 2 complaint is common, but if you receive 30, 40 complaint, something is off. You got to be careful, right? So number one, to make sure you check the background into this 2 website, my recommendation. Number 2, ask for credentials. Are you a fiduciary? Are you CFA? Are you CFP? I think these are important as well, because there's fiduciary supposed to be, doing the fiduciary work for you. And number 3, are they taking custody of the money? That's very important. Okay, like I don't remember, Dr. Samadar, do you remember Bernie Madoff? This name, Bernie Madoff. What happened that when you invest with them, he used to take custody of the money under his own corporation. So, and then money embezzlement and everything. So first question to ask, okay, if I'm investing with you, where is the money held at? For example, with us, our clearing firm is Fidelity Investments. So this is where the money is held at. So if it's a third party, like independent, you are okay. But if the advisor is taking custody of the money, be careful, ask questions, do your due diligence. Google have most of the information that you need. You should be able to find a lot of resources out there.
Okay. The next topic is estate planning. Can you please explain the top 3 estate planning mistakes to avoid?
Yeah. So going to the estate planning, a couple of mistakes to be wary of. Number one, when you create will and trust, we see 3 major mistakes people make all the time. Number one is they created the will, they created the trust, but they gift everything under the name of the children. So I think logically, there is some other that these children inherit the money after husband and wife both pass away under their own individual name, and they get into a divorce, the assets become half. So the best way to gift it, when you create like a trust, put a provision there in a trust that each children will open their own trust and you transfer the money. Again, when you have your trust, we recommend you put a 1-line provision. It's called they will have their own lifetime trust and transfer money out. Number one, mistakes we see. Don't give it to outright their individual name. Number 2, not funding the trust. What I mean by that, 50% of the work in estate planning is creating will and trust, another 50% funding it. What I mean by funding it, the house should be moved under the name of the trust. The brokerage account should be moved under the name of the trust. If you don't move it, is a fancy document collecting dust. So make sure you move everything under the name of the trust as well. And number three, I see that physicians move to different states, let's say from New York to Florida, each state, they have their own statute. Just update it. It's a couple of page documents. You just have to update it to have the latest provisions there. So, and they don't like, they created like 6 years ago. I think it's every 5 years we recommend to update the will and trust document. So these are the top three mistakes we see. Number one, not have the lifetime trust provision. Number two, not funding the trust. And number three, not have the latest provision into the trust document, not updating it.
Great. I have joined with the right of survivorship account with my spouse, but I want the assets to go to my daughter in my will. Which one will supersede?
Yeah, so it's a very good question. So the funding of the will and trust should align with what your objective is in the titling. So what I mean by that, we have a situation where all the assets are owned jointly with the wife, but the husband's intention was to give everything to the daughter. So there's something called law of operation. According to law of operation, that title supersede the will. So what I mean by that, if the assets are joined with the wife, it doesn't matter what you put into the will. It will go to the spouse because because the law of operation mentioned that it's already joint with right of survivorship to the spouse, it goes there. So the right way to do it, if you want to have it to the daughter, have the own have the account owned by the trust or have the beneficiary of the account should be the trust because you wanted the daughter to get it. So again, the title supersedes the will. So be careful about that.
Okay, great. When do you use revocable trust and when to use irrevocable trust?
Yeah. So a lot of people have this confusion that revocable versus irrevocable, and they ask question that my lawyer told me I don't need any revocable trust because my net worth is not that much. That's not the case. So revocable trust, the advantage is, what is a revocable? It's a private document. It avoids probate. If you just have a will, you pass away, husband, wife, it's not like tomorrow the children gets the money. It goes to a probate process and the children get the money after 3-4 months. You can avoid all of it by creating a revocable trust, which is a private document. The advantage of revocable trust, if you pass away, the children inherit it. As long as the money stays in the trust, all the assets are protected from divorce. Again, we keep talking about revocable trust. And lastly, in a revocable trust, there's something called step up in cost basis. For example, if you own Apple share at $100, it is under the name of a revocable trust. You pass away and stock right now $200. For the beneficiary, the descent, the cost is $200, not $100. So again, very powerful. You get a step up in cost basis, pretty much tax free. So this is again for revocable trust, just to avoid probate. Irrevocable trust you created when you want to gift it, to just simplify it, and asset protection. So only if your net worth is substantial, you want to gift it, irrevocable trust, and if you want to do asset protection. So hopefully it makes sense. Again, revocable trust, mainly to avoid probate, irrevocable trust for gifting purpose and asset protection. If you can remember it, go to the attorney. It should help you a little bit.
Okay. Is there any estate planning changes we have to be worried about?
Yeah. So two major things the estate planning attorney to be worried about. A lot of physicians are not kind of aware of it. One is Secure Act 2.0. Secure Act was passed in, one is Secure Act and the second one is Secure Act 2.0 a couple of years ago. You might be thinking, what is Secure Act? What does it do? According to before Secure Act, if you have a retirement account and you pass away, the children inherit the money. They had their whole life to slowly take the money out. The children I'm talking about. You pass away, your children inherit the money. They have their whole life to slowly take the money out. After Secure Act, they have to use all the money within 10 years. Again, the children inherit the money, everything must be used within 10 years. I think it is important because they have to worry about paying a lot of taxes, especially if it's a retirement account. Most of the trust, for most of the retirement account, the beneficiary is in the trust. And the trust is not equipped to handle Secure Act 2.0. So make sure you update it. Talk to the attorney about Secure Act 2.0 is very important. And number two, there's some other is, as of right now, if your net worth, husband, wife both pass away, up to about 24 to 26 million, there's no estate taxes. Again, both of you pass away, up to 26 million, there's no estate taxes, but it is expiring next year, 2025. Husband, wife both pass away, anything more than 12 to 13 million, we're talking about 40% estate taxes. So I believe that some of the things should be done. And one of the things to very quickly talk about something called SLAT, Spousal Lifetime Access Trust. In an irrevocable trust, you can gift money, like the way I mentioned, revocable versus irrevocable. If you remember, this is an irrevocable trust. You can gift money. All the money is out of your state. It grows estate tax free, but it is a type of trust called irrevocable trust, called Spousal Lifetime Access Trust. As long as your wife is alive, your spouse is alive, you have access to it. So again, I just want to like point out the important point, the detail. If I want to go over it, it will go over like a couple of hours and it's going to be boring. So I just want to point out there for physician or high net worth, make sure you speak to your attorney about these two, Secure Act 2.0 and gifting assets via SLAT. I think these two major important points.
Okay, thank you, Syed. And can we go to the question answer sessions now? Because
Sure.
we have quite a few questions. First one is from Dr. Abdullah Mubarak. His question was, what do you think of JEPQ, JEPI, and QQQI as call-based option with 8 to 14% yield and cap appreciation?
Yeah, the answer is don't have to do all of this. You know, I understand it's very sophisticated. Retail investors, yes, but leverage ETF or covered call versus option, we are not comfortable with it. I understand there's a 8 to 14% yield, but it fluctuates a lot. It's impossible to understand how the call and the cost of the covered call, covered put will go down. So why get into it? My question is just buy the plain vanilla, index fund. That should be enough.
Okay, the next question is, what is your thought on senior secured bonds, BBB plus? Is it safe? The interest rate given, is it true, or I have risk of losing money?
Yeah. So if you have a long time horizon, so BBB means it is not the best rated. It is after AAA or AA. We recommend AA. Obviously, that's the best route to take because of the default risk. So if you have a long time horizon, the lower graded bond fund have a high rate of return expectation, but you have to have a high risk tolerance to do so. So our recommendation is at least AAA net rating. If the rating falls, at least you have a shot, I believe, before you get out of it. So we believe that rather going for triple B, unless you have a long time horizon, I recommend AAA. Number one. Number two, if you think that the interest rate will go down, I understand you want to buy bond, but there's a bond fund out there called BND, what I was saying. Index fund, you can just buy that. The price is an intermediate bond fund. The price should go higher if the interest rate drop. So if you have a long time horizon, it may be okay, but usually we would like to buy at least A rating bond fund.
Okay. Are annuities bad even for people who are retiring or on the verge of retirement, especially a few which do not have fees?
Yeah. So for example, it's a good question. So remember, I said that to take a look into the fee. I also mentioned there can be made into annuities. Vanguard annuity, for example, like a deferred annuity. There's no income riders there. It's okay because the fees are very low. So as long as the fees are not crazy high. But most of the times, Dr. Samadder, if I add death benefit, income rider, all of it, the fees goes, and mutual fund expenditure goes almost about 3 to 4. So as long as the fee is below 1, I'm okay with it.
Okay. How about getting into insurance and or annuity for offsetting the estate taxes?
Yeah. So remember, we spoke about insurance as an investment. It's not a good idea, but insurance as a death benefit, that's the whole purpose of it. So yes, we believe that you should buy insurance called ideally second to die life insurance. Because remember, both person, husband, wife needs to die in order for state tax to kick in. So the best thing to do, buy second to die life insurance called universal life policy. And usually it's very cheap. You can buy 7 pay, 10 pay, you just pay it, it's paid up, and it's have a huge a benefit. So yes, it's a good idea.
Okay, Dr. Chetan Shah asked, what about house under trust?
Yeah, we do recommend house under trust. A lot of people have this confusion that, hey, if I put house under the name of the trust, I mean, some states have asset protection. Do I lose it? No, no, no. The trust can be implemented in such a way, revocable trust, the homestead asset protection could be there. So don't worry about that. So if you have a huge house, and you want to, avoid probate, gift it to the children, ideally we would like to see the funding is done either TOD or the house is owned by the trust via the deed transfer.
Does your company help with updating trusts?
Yeah, absolutely. So we have attorney we alliance with. They can help you update the trust as well.
There's a lot of talk about sunset provision of the current estate tax limit exemptions. What is SLAT? What is a generation skipping trust? Is it advisable to update trust, keeping in view this upcoming changes?
Yes, absolutely. So I think it's very important not to, update it. I think the update, what I mean by that, the revocable trust provision should be updated. Remember, revocable trust is just to avoid probate, nothing else. There's nothing to worry about state taxes. If you're asking about state taxes, we have to talk about irrevocable trust and SLAT, SLAT. Like the slide is in front of you, spousal lifetime access trust. This is a type of irrevocable trust. The problem with irrevocable trust, Dr. Samadar, if you gift it, you lose control over it. But I don't want to gift everything. Is there any way I can basically have an irrevocable trust where I can have some control? SLAT is a good way of doing it. As long as the spouse is alive, the spouse can take money and give it to you via spouse. So that's why it's called SLAT, spousal lifetime access trust. What is general skipping trust? One option could be, rather giving it to the children, you can gift it to the grandchildren. So what I mean by that, you skip a generation. So that's at that time, skipping taxes are due, GST. You can create a trust to avoid it. So that means you just pretty much skip one generation. If your net worth is substantial, you can think about it. Yes, the argument can be made. Now, to update the irrevocable trust, our recommendation to wait and watch. What I mean, you don't have to do it today. Have everything ready, watch the election. Sometimes towards the end of the year, you can make a decision.
At what value of asset protection should we do revocable trust?
Yeah, remember, revocable trust, there's no asset protection, just to avoid probate. Irrevocable trust, there's asset protection. If you need asset protection, there are other vehicles as well. For example, family limited partnership, domestic asset protection trust. You can think about it as well. Those are part of, depending on the state you live in, revocable trust, there's no asset protection whatsoever, usually. We would like to see net worth. What I mean by net worth, you have liquid or asset exposed to creditor at least more than 2 million to implement some of it.
Can you advise about backdoor IRA?
Yeah, so a lot of physician, what happened because of your high income tax, don't qualify for a Roth IRA. But you can open up a traditional IRA over the age of 50. Both of you can, husband, wife, this year I think can contribute about 8,000 each, is about $16,000. You can contribute post-tax money into the traditional IRA. Post-tax means no deduction you took. Since you took no deduction, you can open up a Roth IRA at the same time and transfer the money instantaneously from a traditional IRA to Roth IRA. since you did it instantaneously, there's no taxes, hopefully, because you do it very quickly, and there's no, it's a post-tax, so there's no taxes on the conversion. So it's called backdoor Roth IRA. So it's very powerful because it's a Roth IRA. Once you convert it, money grows tax-free. Withdrawal is also tax-free after the age of 59 and a half. One thing to worry about is you cannot have existing IRA account open, traditional IRA account, because there's an exclusion rule came into play. So as long as you have no other IRA account open, you can do a backdoor Roth IRA.
Okay. What do you think about structured notes offered by banks?
If you are a very, very conservative person, yeah, some of the structured notes are there. But again, as I mentioned, that the fees, the cap ratio, the structure road, Dr. Samadder, the way the process work, they're giving you like some upside potential and principal are guaranteeing you. I mean, think logically, bank is doing it because they know, like if you hold it for 5 years, they usually lock up like 5 years, 6 years, 2 years. They know that if you hold it for long term, they're going to make money. They're not stupid. So they're taking your money, investing, and giving you like a cap. My question is that why can't you just do the same thing? Just have a long time horizon, for God's sake. I mean, don't listen to them. Buy it, forget about for 5 years. You'll be fine. So that's why we believe in not lockups and everything. Just buy it and hold it.
Which trust is better, SLAT or Dynasty Trust?
Yeah. So SLAT, remember, it's an irrevocable trust. Okay. Dynasty trust, what is that? Dynasty trust is a provision. It's a provision in a revocable trust or irrevocable trust, doesn't matter. So when you pass away, Dr. Samadar, what happened? Usually we say each children, like I have two sons, Ayan, Noah, my two children will open their own trust and transfer money out. It's called division. You can say that, listen, I don't want to divide it. I want to keep everything in my family. Children will take income off of it and everything remains in the same trust. It's called dynasty, goes generation after generation. So you can do this in irrevocable trust or revocable trust, doesn't matter. So dynasty is a provision either in revocable or irrevocable trust.
Can you discuss the pros and cons of cash value life insurance and how does it help with tax savings for high net worth individuals?
Yeah, so there's a pros and cons for whole life insurance. The benefit of investing into cash value means whole life insurance, that you're paying term life insurance, you're losing money, like paying rent, right? The money is going away. Whole life, what the advantage is that the money they pay dividend. In the long run, if you keep paying it, what happened, the cash value is enough to keep paying the policy itself. And sometimes if you pay long enough, the cash value, they can take a loan against it and invest in the market as well. And the loan is tax-free. That's what the whole idea behind it. But Dr. Samadar, it's in theory is good, but in reality, it doesn't work. What I'm saying, that you have to pay it in order for whole life to be profitable or all of this, you have to keep paying it for 20 years. A lot of people get disappointed because they pay for 5 years, 6 years, nothing happened. So our suggestion is buy term life. Our suggestion, buy term life. The difference of the premium, buy mutual funds, buy index funds. So it gives you the same thing. If you're disciplined enough, a better result.
Any thoughts on Matthews India?
Yeah, Matthew India is a mutual fund, or you can buy AAPI, Wisdom Tree. These are good index funds, ETFs. So yes, it's fine.
The horizon is 1 year?
Yeah, I mean, I wish I know where you can invest for 1 year. Tell me if you have it. I don't have anything. Yeah.
What are your charges to help with reviewing a couple's assets and provide optimal estate planning? If we already have a relationship with Fidelity, would it be different?
No, so we are independent. It's just Fidelity Clearing is just our custodian. So we don't work for Fidelity. We use them as a custodian through our broker dealer. So yeah, so there's a charges involved. Usually, to give you the blunt answer, a typical will and trust cost around $3,500 to $4,000. Very plain vanilla. If you have done it a year ago, 2 years ago, the cost will be lower to update it. But if you have done it 6 years ago, 7 years ago, most likely any attorney you go to, they will revamp it. It's too much work to change 1 or 2 pages. So every time more than 6 years, expect about $3,500 to 4,000 cost.
What Vanguard fund to invest for a defined contribution plan?
Defined contribution plan is a 401k type of plan, like a 401k profit sharing. So you can buy, like I mentioned in the slide before, I can go back. You can take a screenshot if you want. Some of them are Vanguard, like VO is a Vanguard mid cap, Vanguard small cap, Vanguard emerging market. On the top, I put SPY, but if you want to buy Vanguard S&P, you can buy VOO, which is like similar to SPY. It will give you the same type of exposure that you need. So just to give you some examples.
At least from published information, do we know the stance of the two candidates on estate planning maximum for tax exemption?
Yeah, I wish I would know the answer for that. I would be doing the planning like 10 years ago. Yeah, I don't know. Yeah, yeah.
Option of buying annuity from Roth account for non-taxable return in retirement.
Yeah, so you're buying annuity within like a tax deferred investment, so we are not okay with it. You should buy annuity in a um, non-qualified account. That means like in a brokerage account, at least it's tax deferred. So we're not okay to buy annuity in retirement account.
Okay. Can you have your nephew slash result as successor trustee if your kids are young?
Of course, you can have anyone as a trustee.
Real estate owned by California LLC. LLC sole member is Living Trust. Does Living Trust provide asset protection in this scenario?
Yeah, so remember the owner of the LLC is your living trust. It will be protected by the bylaws or statutes of the LLC. So it just imagine this way, you are the owner of the LLC. Whatever the asset protection you would get it under revocable trust.
Yeah. Okay. The next question, I think you already answered how much you charge range to prepare trust.
Yeah.
So give an answer. Then someone asked a question relative. I don't know what it means, just relative. How about investing some money in safe funds like NVDY, India, QDTE, etc.?
Yeah, I think it's a joke. I think she's saying safe funds, like I think it's a joke. Nvidia and stuff. And Nvidia is very expensive. It's a it's a high flying tech stock. But if it's like a fund, a simple fund like Vanguard short term, I think is fine.
Any role of ILITS, ILITs?
Yeah, so ILETS is called Irrevocable Life Insurance Trust. So basically, life insurance is part of your state if you pass away. So basically, yes, for estate tax purpose, it does makes to create an ILET if your net worth is more than 5 million. If you have life insurance, move it to ILET.
Okay, I think you answered the next question. How often to revisit the trust? I believe you said 6 years.
Yeah.
About the next question was, can you have backdoor Roth IRA and SEP IRA?
No, remember you cannot have a IRA account. SEP IRA is a traditional IRA, so you cannot have a SEP IRA. The exclusion rule, the calculation, conversion rule comes into play.
What is a high income individual?
Anyone make more than 400,000.
Is it advisable for spouses to create SLAT where they both mutually gift each other half of the assets separated by a year?
Yeah, so basically what happened that it needs to be not exactly same reciprocal. It needs to be something different. You're gifting it. So you can gift each other, which is absolutely fine. Each other's exclusion, you use it and gift it, but it cannot be like the same type of property. Like if you're giving stock, ideally you should give some real estates. So, but yeah, it is fine as long as it's not exactly the same. There's something called reciprocal clauses out there. I mean, we can sit down with the attorney and he will explain further. But SLAT is a good idea if you want to have the state out of your state.
Okay. For backdoor IRS, do you have to have earned income?
Yeah, so remember, if you in order to qualify it for IRA account, you have to have earned income, right? So you have to put the money into it. So that becomes backdoor.
Roth IRA, when ready to withdraw at age 67, given our high income, we will be paying on the income when we retire. So is IRA beneficial?
Yeah, so Roth IRA, remember on the withdrawal, there's no taxes. It grows tax free. IRA, you do have to pay high taxes. After the age of 73, the RMD comes in, the required minimum distribution comes in. So yeah, too much money into IRA account may not be a great idea. You may have to do some sort of planning to save money in taxes.
If you have a traditional IRA and then do Roth IRA, do you have to convert all of traditional IRA and pay taxes?
You can do half-half, no problem, any amount you want.
For someone with a young family, early 40s, what should an ideal risk profile be? Growth or aggressive growth?
Yeah, 40 and your budget, everything is completely taken care of. I think the best solution would be you have enough budget, everything is being taken care of, your house, mortgage, everything is fine. You should be growth because you don't need the money for 20 years.
What about investing in crypto? Is one crypto better than the other?
Yeah, so we are, overall our firm doesn't allow, our broker doesn't allow to buy crypto. Because we just don't understand the valuation, how it works. But and arguments can be made, it will become at one point legalized and the price will go high. I understand, but our firm doesn't allow, broker doesn't allow to buy crypto.
With cash value life insurance, are there tax benefits? Does the money grow tax deferred?
Yeah, so whatever the growth happen in the cash value, it does grow tax deferred. Yes, it is true. But as I mentioned, the growth is not there in, so if, as an investment perspective, it's a bad idea to invest into life insurance. I think
Why
Dr.
not buy
Samadder,
van?
sorry, go ahead.
Yeah, go ahead.
I think there's a lot
No,
of questions,
okay.
so
Why
let's
not
go.
buy van?
Yeah,
I know, tons.
yeah, let's go to
We'll
the
ask
other
the last
slide.
one. Why
Uh,
not?
yeah.
Sure. Okay. What are the tax planning tips for 2020 physicians? Where physicians should pay attention to?
Yeah, your voice cut a little bit, but let me just repeat the question. I think you can hear me okay, right?
What are the
Johan,
tax planning tips for 2020?
Syed, your voice is fine. Dr. Samadder's voice
Hello.
is breaking up a little bit.
that's fine. But Dr. Samadar, let me repeat your question.
Oh,
It's fine. You just asked a
sure.
question that what are the tax planning tips for the physician for the year 2024? Last topic. I think I just want to cover real quickly. The year we are a mid-year, we are a good position to do some of the tax last minute tax planning tips. Number one, when Trump was the president, the maximum state and local tax was $10,000 deduction. But recently, some of the states like New Jersey, Georgia, the state, Dr. Samadar, you live in, Ohio, they passed law.
Mhm.
If you have your own corporation, let's say S corporation, and you owe state tax, and you make an election, you pay all the state tax from the corporation by December 31st, you get full write-off. Again, very powerful. Right now, if you don't do anything, if you pay state tax, the max deduction, including property and stake, is only 10,000. You have your own corporation, you pay the same state tax from the corporation, you elect to pay for it, and you pay everything by December, depending on your state live in. And if you're self-employed, you get full write-off. Very powerful. Number one. Number two, if you ever need a bigger vehicle, this is a good year to go because what happened, most likely it will expire. If the car weigh more than 6,000 pounds, last year full deduction. This year, the CPAs are doing some number crunching, but you get a huge deduction. If the car weigh, let's say Tesla Model X, people buy it all the time. Car costs about $43,000. You use it for the corporation. If you need it, you get the full write-off almost due to Section 79 deduction. Number three, Dr. Samadar, a lot of people, our Indians who are especially Gujarati, they invest into real estate a lot. They do. But if you invest into real estate, the benefit is there's a depreciation schedule. Typically, commercial real estate, the depreciation schedule is 39 year and residential is 29 year. But the schedule is up to you. Meaning if you want to bring the schedule from 29 years to 5 years, the benefit is you get a bigger depreciation and all the rental income you can write off from it. So I had a client in Texas, surgical center. We bought it for the client for $2 million. We did cost segregation. number 3 points, I'm pointing it in the slide, number 3, cost segregation. For a $2 million, we get almost around $600,000 advanced depreciation. The benefit is this client will not pay taxes up to about 300,000, almost about $600,000. So again, very powerful cost segregation. If you're a high tax bracket, it's a good time to do so. Advanced depreciation. A charitable contribution. So a lot of AAPI members, they donate into AAPI, Temple. AAPI needs your help. I'm not, I don't work for AAPI, but if you think that AAPI, you want to support AAPI, you want a bigger tax deduction, you can open up like a donor fund or charitable trust. Next 5 years, donation, you can lump it together, put it into the donor fund. The advantage is that you get a huge deduction because you lump it together. The money is in your control. You can see how Dr. Samadder is doing. If she's doing a good job, then slowly give the money, maybe. So, but in this way, the money is in your control. So again, you can do like a charitable trust, charitable planning, but all needs to be done by December though. So just speak to your CPA if charitable planning makes sense. Defined benefit plan. A lot of physicians who are young, starting self-employed, they're aware of it. In a defined benefit plan at the age of 60, you can contribute almost $200,000. The money is all pre-tax. 401k, 403b, by December, you have to contribute. If you are extension for the last year, you can still open up a defined benefit plan. Again, if you're an extension, last year, you can still open up a defined benefit plan. 5 to 9 contribution. By December, if you contribute, you get state tax deduction, not federal, state tax. Like New York has a huge state tax deduction. And couple of deduction not to miss, like there's something called QBI, qualified business income deduction. If your income is below certain level, I believe the amount is about 450 for 2024. If you're self-employed, if your income is below 450, on the K1 portion, you can collect something called QBI. QBI is 20% of the income you can write off as a deduction. Again, very powerful. And you can speak to your CPA about QBI for rental income as well. So let's say if your rental income is $100,000 after depreciation, 20% of $100,000, the government give you a QBI as well. So again, speak to your CPA before the year end. If you qualify for QBI, try to bring the income down if you're self-employed below $450,000. And lastly, tax loss harvesting. Let's say, if you have stocks which are down, like a lot of people bought companies like Neo or stocks which are speculative, they are down, sell those if you need to and buy something similar with this money. The benefit is the loss carry forward, and the loss you can write off from any future income you have from stocks, or if any income you have from property, you can get to write off as well, and it carry forwards as well. So I know I kind of spoke more than I should have for the tax planning, and it's kind of getting late, but the audience, this recording will be there. Take a screenshot, we will email it to you. This is a good list to have and sit down with your CPA and do the planning in advance for the year 2024. Hopefully it helps a little bit.
Thank you, Syed. It was a great and interesting talk. All your talks are very powerful. So we hope you'll come back soon and enlighten us. And Mr. Syed has been very generous, and he'll be with us at the World Health Congress, and he'll be there live answering all your questions during the 5 days. So please, all of you, come to the event, and any questions you have, I'm sure he and his team will be more than happy to address. Thank you once again.
Thank you, Dr. Samadder, for your hard work for AAPI members, and thank you very much. We really appreciate it. Thank you for the thankless job you do for AAPI. You and Dr. Sumul Rawal as well, both of you. Thank you.
Thank you. Thank you so much. I appreciate it. Take
Good
care.
night,
Bye-bye.
everyone. Bye-bye.
Good night. Bye-bye.
Good night. Bye-bye.